it's funny. I was sitting at a lunch. This is now a year ago, Digital Asset Summit, where a crypto founder was talking to a room of institutional allocators and traditional businesses and said, "Hey, like BUIDL is $1 billion. Like, doesn't that get you excited?" And one of the asset managers was like, $1 billion. Raised their hand. Was like, $1 billion is nothing to us. We're an $8 trillion asset manager, and so now only with like clear regulation, are these folks moving to the space? I would say for us, what changed is we were always architected around traditional asset managers, custodians. So State Street has been our custodian since day one. Van Eck is the asset manager. And what it did change is now we're becoming a federal bank, which even a year ago I would have never thought I would have to do. But we announced our filing for the OCC a few months ago and have been going through that process. And so that I would say has really been like the major change from Genius is bringing traditional businesses into the space through the comfort to do so, but also putting a bank regulator in charge of stablecoins.
I definitely agree. I think with more regulations, we have more companies that are comfortable using stablecoins. At Cap, we're in the business of lending stablecoins. We lend stablecoins to film productions, to HFT firms, to manufacturing plants. And if they're not comfortable holding stablecoins, we can't lend stablecoins to them. And so now what we've seen since Genius Act and now with the incoming Clarity Act, we have a ton of traditional businesses that have never used crypto before that are comfortable borrowing stablecoins.
Okay. And did you need to engineer like your architecture about the regulation?
Well, we're not an asset issuer.
Yeah.
I guess we could have gone the way of making our own stablecoin and then using that to then lend to people. But then we would have to do everything over again, right? On and off ramps, liquidity, etc. We would also have to worry about Genius Act. But instead, we decided to build on top of stablecoins, such as like what you would have at Agora or at Frax. And so we rely on their infrastructure.
And I think the way we do things is probably a bit different from all the other speakers here, because on the FX side, we don't have to comply. Just as Sam correctly said, we're building a decentralized stablecoin. So the idea is to actually offer something resilient, whatever happens, whether it's a regulatory change or whatever. So the idea is that we abstract trust completely from interacting with the stablecoin. So you don't need to trust any custodian. You don't need to trust any government decision. You don't need to trust any asset manager. You just need to trust the code, which has been audited 16 times and paddle tested over time. So it's a completely different approach that didn't require for us to change anything because we want things to not change, actually.
Okay, yeah, in your case, definitely not. Maybe it kind of navigates your customer base and use cases, but definitely you need to change things. Okay, let's move to the question where in your design the yield actually is coming from and who bears the risk.
Yeah, I can start. Actually, Ben said something really interesting, the last question, which is like they lend stablecoins, right? There's basically two types of stablecoins. One is stablecoins that are not lent and they're not backed by initial debt, right? They're only backed by government treasury debt, right? Which is the asset you're pegging to the dollar, right? And those are the things that are accepted widely as payments. If you actually go read the Genius Act, the name for the stablecoin that is Genius compliant is called a payment stablecoin. It's meant to actually be accepted in wide economic activity, in banking, in commerce, and everything as a unit for a dollar. And that's a very different function than a thing that looks like a dollar that pays you yield, right? Like you're not going to have banks, merchants, Visa, cards, networks accept things that look like a dollar, but they're actually yield products. Those are two very different, very large, big markets individually, but they're very different, even though they're called a dollar, right? And so stablecoins like Agora's AUSD or like Frax USD, where the goal is to maximize the amount of places that accept it as payments as a digital dollar. The only way you can give yield is up to a treasury yield, right? The risk-free rate that complies with the Genius Act. Now, eventually, once a bunch of places accept the stablecoin, some people would want to borrow it. You can create debt denominated in it. platforms like Cap Money can actually start using it to issue their own kind of notes, right? There's like something called Cap USD, which is a token that pays yield, right? Which is not a payment stablecoin, right? But it's a yield stablecoin that is a dollar-denominated asset. So these are two very different things, right? And so for these things, there's essentially a fork in the road. You either go in the maximized payment acceptance strategy, or you go in the maximized good risk-adjusted yield strategy. You can't do both by definition.
I mean, for us, just to answer your question, our yield is very different, right? It's not risk-free. It comes from the economy. So instead of getting the U.S. Treasuries rate, we give you access to a wide range of economic players, anywhere from HFT firms like Susquehanna or IMC Trading, all the way to film productions in Hollywood, to manufacturing plants in Boston or in Europe. We give you yield from all of those activities, and we've packaged it in a highly liquid instrument. That's much more liquid than you would see like an Apollo or an Ares, because our platform functions like a vending machine. You can get your money in and out, and you will get it very quickly, because everything that every part of the system that touches money is automated. And so we're able to make the system more liquid. How do we cover the downside? Who takes the risk? Well, on the back end, we have a credit default swap system, right? A whole marketplace of credit default swaps where institutions, not retail, get to underwrite each and every one of these loans that we're giving out, so that our retail depositors that are not on the sophisticated side are maximally protected from these defaults.
Yeah, and then for us, just how we're structured, it's very vanilla. State Street's like the asset manager of the Agora Reserve Fund, or sorry, they're the cash custodian of the Agora Reserve Fund. Van Eck is the investment manager. That's in overnight reverse repo, short-dated U.S. Treasury bills, and cash at GSIBs. So we primarily use 5 different counterparties, and then we also have to have additional banks for minting and redeeming. And the reason that we use that is for our customers, right? So, and no pun intended, Customers Bank is actually one of the most frequently used banks, because they have a 24/7 fiat ledger system. And they're one of the few banks that can move money between counterparties within that system on a 24/7 basis, which is great. And so we have cash there, and 1 or 2 other banks that are useful for us and for our customers. Obviously trading firms really like that, and payment businesses as well. But very straightforward in terms of our construction. We're not natively yield bearing, and so we accrue the interest from the reserve fund, and then we have what we call the AUSD loyalty rewards program, where we can distribute and share revenue with customers and clients of ours that are KYB'd, and then they can choose to do with that what they wish.
And on our end, all the yield generated is generated by on-chain activity. So there's 2 kinds of users on FX: those who want to borrow against ETH or BTC and gets probably the cheapest and safest place to do so. They just pay a one-time fee, and those fees goes to the stable yield strategy. FXUSD natively doesn't earn any yield, but you can stake it or stake USDC to contribute to keeping FXUSD spec. And when you do that, you earn the protocol revenue. And the main risks are mostly due to volatility. So whenever the capital is very volatile, there could be a risk for the backing of the stablecoin. And when there's a huge selling pressure on the stablecoin, it could also lose its peg. But we integrated the whole peg keeping mechanism and a very innovative liquidation design to make sure FXUSD is always over-collateralized and with the perfect peg, without having to rely on external parties, market makers, or whatsoever. It's completely protocol integrated into the code, basically, that you can check anytime. And we deliver right now something like 9% APR on $60 million, completely organically, transparently, without having to rely on anyone.
Okay, thanks. And since you already touched on the actual yield, I just wanted to do like a bit segue of it, because you all mentioned that you don't really compete on the yield itself, or you compete on the multiple factors, being distribution, customers, the risk. Can you go more in detail on who is your customer, and also if there is other competitive advantage you kind of pursue?
Yeah, I mean, what I'd say is I really don't like when people lump stablecoins into like one bucket because they're very different. You know, what people refer to as stablecoins can be very different products in very different markets. Like the way that I think to oversimplify a bit is think of like stablecoins as like the fixed income market, right? Like, you know, some people are providing yield and that's why people hold those stablecoins. But what is a payment stablecoin under Genius, they are not allowed to pay yield, right? And so the definition, like legally, of a stablecoin is, you know, they don't pay yield, but a lot of stablecoins do, right? You know, another big one is, of course, Athena, Sky, et cetera. So for us, the main reason that I think people are using, you know, AUSD today is for payments, for trading, but really that all stems from like our integrations into different applications, right? So you know, I was meeting with you know, a vault provider, you know, earlier this morning, right? People use AUSD to create their fund products, right? And then, you know, there's many different things that people may do with those fund products. They may lever it up on chain or do other things, but that's just like an additional node in our network that makes AUSD have utility, right? I would say the stablecoin with the most utility today is, you know, and this could be a, you know, big argument, but it's probably Circle, to be honest. Obviously, Tether is the largest, but USDC probably has the most utility when it comes to traditional applications. For us, we're trying to compete with that, right? Like that is exactly like our market. You know, similar to how there's a number of very large payment companies today, right? I think there'll probably be 5 to 10 very large global stablecoin issuers that are multi-utility and have a large liquidity. That's what we're aiming for. And so we work with a variety of different types of companies to start to build that utility. You know, Vaults is one, PerpDex is another, payment businesses, you know, is another, neobanks, et cetera. And so, you know, eventually our hope is that our acceptance network is so large that it's self-sustaining and people just build on it because it can attract clients for them, right? It's why USDC today is largely the default, is because, you know, most people have it, most people use it, it's widely accessible, and so if you are an application builder, most people start there. And so that's, you know, our market and who we're really competing with. I think, you know, a number of these, you know, folks on stage we've worked with before, right? Because they have unique applications that attract users, and we want, you know, to take part in that.
Yeah, I think we definitely all compete on different things, right? We're not a stable coin, so we won't go to chains to try to white label stable coins or anything like this. Our success metric is how many companies can we onboard to use our platform, right? Can we have a manufacturing plant in Korea borrowing from us? Can we have a trade financing firm, you know, borrowing from us? That's really who we're trying to onboard. There's not many people doing that on chain. And so to be honest with you, we're not necessarily competing with anybody on chain. We're competing with a lot of credit funds, boutique credit funds outside of the blockchain. And can we be faster or cheaper or both? That's really, you know, what we're trying to do. On the supply side, on the dollar side, yes, sure, there's many products on chain that give yield. Like you can put your money on FX, you can put your money with Cap or Frax, etc., to earn yield. But they're widely different products, and I think the user bases are completely different.
Yeah, I'll just give a direct example from the stage here. Like Frax USD is a redeemable dollar, right? It's Genius compliant, like Agora, and so we actually, instead of a loyalty program, stream the risk-free rate to different hubs on chain. One of them is Curve. So if you have like a Curve pool with a bunch of Frax USD in it, it's like having USDC. But then every day you get streamed the risk-free rate based on how much of the Frax USD balance is in there. While Circle keeps it all, right? It goes to their revenue. Same thing with Aave. Aave recently added Frax USD in their V4, right? And if you lend, you'll get the risk-free rate, right? And then whatever borrowers pay. And so, for example, FX USD has a curve pool with Frax USD because one of the things is that if you have a redeemable digital dollar, these synthetic dollars have to have some decentralized liquidity, right? So that people can trade against it at $1. And so we actually stream the risk-free rate into the FX USD pair that actually helps create even more loans for the FX protocol because there's a deeper peg for the synthetic decentralized stablecoin, right? And so there's just a lot of things that we really don't compete, and it's actually synergistic. So like one of our goals would be if Cap starts denominating some of their lending, right, in Frax USD or AUSD for Agora, right, instead of USDC, right? These are totally different layers. The same way that, for example, in the traditional financial system, banking money, M2 money, is totally different from M1, right? So that there's this layering that's happening where Genius compliant stablecoins are essentially M1. They're kind of the monetary base of the crypto ecosystem. And then the M2 money, right, which is like the debt denominated that on demand can get turned into M1, right, is what people like Cap are building. And so I think it's really interesting because if you know where you are in the financial ecosystem, you can bring a lot of value to everyone else.
Actually, I would say the projects like Frax or like Agora are competing a lot more with money market funds. If you look at Genius Act or now the Clarity Act, they don't limit how these money market funds can pass on yield to their users. And so they've been completely left untouched, and they can now service as dollars on chain. They're pegged to the dollar. They're very easy to on and off ramp. You can on ramp $1 billion of Benji without a problem, and Franklin Templeton will service that for you. You don't need to go through a third-party provider, which is fantastic. I mean, even for us, right? Why wouldn't we just lend Benjis or something like this? The answer is because they're slow compared to like Circle. But I really see that being an interesting battle coming up: stablecoins versus money market funds.
Yeah, just to add super quick on that. Since we built Frax USD very recently, right, during the same year Genius passed, a lot of our backing actually is not bank deposits, but tokenized money market funds, just like as Ben's saying. And it's actually on chain. It's backed by BIDL, USTB, which is a super state, RWA that's Genius compliant. And so we've actually purposely designed it in a way where it's in all of these RWA issuers' interest. Like if you issue a money market fund on chain and your KPI is to grow AUM, one of the things you probably want to do is come talk to us and say, can we get part of the Frax USD supply to actually hold our tokenized money market fund? Because the more people use Frax USD, the more the supply grows, the more their AUM grows. So it's actually, you're right in that we do kind of compete, but we've flipped it around in the sense that
Depends how much you want to vertically integrate. I feel like you guys are pretty vertically integrated, right?
We're very vertically integrated. Like our view is like you want to own the rails because then ultimately like this is a scale game, right? And so if you can get marginal basis points, I was talking with Sam about this before, right? Because of Genius, a certain percentage of your backing will need to be in bank deposits. Like I want to be able to go to JP Morgan or whoever and say, hey, give me EFFR minus like 10 basis points, right? And that's that makes a difference, right, on your economics and then what you can give out to partners. What I'd say that's slightly different is I don't really view us as competing with like money market funds as much as like view us competing with like the Eurodollar market and dollar deposit accounts offshore, where you either are earning really low yield on your balances or there's very large transfer time, right? And even Robinhood, right, has talked about how they use stable coins for intercompany transfers. Like that's the market that we're going after. I think stablecoins outside the United States are 10 to 100 times more valuable than within the United States. I think they'll of course be adopted within the US, but like our focus is really eating that Eurodollar market.
And yeah, regarding competition, on our side, competition is very, very low because decentralized stablecoins are like 0.3% of the 300 billion stablecoins. So we're on a blue ocean niche. And I think that, as the others pointed, there's good synergies actually between the different models. So we need compliant stablecoins for off-ramping, and they could also need the competitive yield we generate to add some yield on top of their product as well. So there's good synergies, and the ecosystem probably needs both different approaches.
Yeah, I think it's a good connection between the yield and distribution, like between you guys. So let's just quick follow-up question on how do you use, or if so, yield for distribution or creating the partnerships? Like, do you share with your partners and because since we cannot share really with the retail user, that's the strategy, right?
Yeah, so for us, it's businesses, right? And that could be payment companies, it can be perp dexes, it could be, asset managers, whomever, right? And it's very much business oriented where we basically track the assets that they're holding, pay it through to them and say, hey, you can choose to do with it what you want. which is I've always thought was the better strategy because there are very many different businesses that we interact with, and they know how to best use money and spend for their business, and so that's how we work.
Yeah, for us, it's essentially on-chain yield streaming of the risk-free rate in the most important DeFi hubs on the most important chains. So I already gave Curve and Aave as like an example, but if you go right now and lend Frax USD on Aave, you'll get around like 0.9 or 1% or something from borrowers, just because there's not a lot of borrowing right now. But you'll also get 3.4 something last time I looked of the risk-free rate. So when you add up all of that in total for lending Frax USD, a Genius compliant, redeemable, safe stablecoin into Aave, you'll get about 4%. And that's constant. It's not just a campaign or like an airdrop. It's a mechanism that we've built in partnership with Aave. It's a mechanism we've built in partnership with Curve and the Curve pools, and we're building a lot of them in really important places. So you could kind of think of it as like a DeFi risk-free rate loyalty program that is on-chain. You can see what the balances are, the history of the streaming to the individual addresses. It's like if you wanted to redesign fiat coins, right? But for 2026, how would you do it? You would distribute this for activity, right, which is very different than idle holding, right, which is what banks are trying to essentially prevent in the Clarity Act, where you don't just hold a stablecoin idle and you get the money market fund essentially, right? You have to actually put it somewhere, and that's fine with us, right? Our goal is to make our Frax USD stablecoin used everywhere, and the way to do that is to bring the actual yield into those specific places.
Okay, thanks.
Yeah, I think there used to be a time where a lot of the way that you grow your stablecoin was through integrations of DeFi. Like you would go to Aave for leverage, or you would go to lending markets, other lending markets, maybe Olympus DAO for deposits. But now it's really the neobanks and maybe the chains. And so, the biggest guys like, let's say Sky, if Sky's depositing into you, you're getting a lot of TVL. If, Justin Sun, if, EtherFi, like these are the guys that are really the big depositors into all these protocols. And if they're not using your protocols, you're not growing. And so I think the game has definitely changed to more sophisticated players, which means you don't necessarily have to have 20% yield. You just need to have something that's willing to, like, enough to convince these sophisticated players.
Yeah, and something sustainable.
And that's bear market too. There's just no retails to use the protocol right now.
Yeah, really.
Okay.
And on our end, it's very simple. We distribute the yield to the users. That's
Fully.
No shenanigans. And then you can just we harness DeFi composability. You can just use FX Save on Morpho, on Pendle, on other protocols to just harness DeFi, the beauty of DeFi composability with minimized trust.
Okay, yeah, that comes from the design differences for sure.
Yeah.
So let's talk more about the design itself. Are we converging into some dominant design, at least for particular use cases, like we discussed the difference between payment and yield stablecoins?
No.
No. Okay.
Outside of Genius, right, where there's very clear regulations, right? This is like it's like if the fixed income market, right? There's new different types of fixed income products, every single week. People are still coming up with new fund structured products to this day in traditional markets. And so I don't think there will be any convergence on different types of models. I think this is still extremely early days for yield coins. So no.
Well, actually, I think today in the yield coin world, everybody has moved away from, what strategy are you running? Like, are you doing some delta neutral strategy? Are you a CDP stablecoin? We've moved all away from that into allocation. So Sky is a fund of funds. Ethena is a fund of funds, or private credit, or whatever you want to call it. And they're all just allocating. And so I do think we're all converging in the altcoin space at size. Everybody's an allocation engine. And then who is the better allocation engine, right? Ethena is, an internal team making all the decisions. Sky is, you have this bigger group of a committee of different maybe DAOs or maybe sub-DAOs that are allocating the funds. At Cap, we have rules, right? We have this credit default subsystem to allocate capital. And your analysis of who's better will depend on who do you think is allocating capital better. But definitely we're all moving to that at the moment in the altcoin space. We're not.
We're building a primitive to let allocators use it. it's I guess different approach.
Yeah, I think it depends on your definition of converging. For me, the answer is yes, and everything's converging on two types of things. It's the digital dollar that's compliant, redeemable, and a few of them will have large economic activity denominated in them, widespread merchant acceptance, bank acceptance, right? As Nick was saying, USDC has probably the biggest lead in this area. And then there's everything else. There's the yield-bearing assets that look like dollars, but they're really, as Ben said very accurately, they're debt-denominated in dollars and they're tokenized, right? You're not going to get a merchant to say, oh, I accept this private credit note ticker that has USD in it, right? They'll say they accept USDC, hopefully Frax USD, AUSD, some other, Genius compliant stablecoins. They'll hold those, right, for like the day's commerce, and then as they have a savings account or a finance department, they'll distribute that into the savings product that actually makes sense for their business, right? Whether it's super safe debt, whether it's CAP, whether it's Sky's SUSDS, whatever, whether it's FX protocol or any other securities, right? So there's just going to be this two forked model, right? That's the way that I see it. But then the second model is all of the, as Nick was saying, it's going to have a billion different types of yield products, right? So it depends on what you mean by that second thing. There's not going to be a world, at least in my opinion, where everyone is going to accept at the point of commerce and the point of on-ramps and the point of cross-border payments a long list of random tickers with USD in it that are some more like private credit, some more like risky debt, some yields and things like that. That day existed in crypto, by the way. In like yeah, that day existed years ago, right? Where people thought, oh, you're gonna send in anything, and it's just gonna get converted like automatically or things like that. Actually, it turns out pricing and denomination is a very, very sticky thing. It's a very sticky network effect because denomination at the point of commerce and at the point of sale and cross-border payment and settlement is a very, very powerful thing. You're not going to have many stablecoins win that. Maybe 5, maybe 6, 7 in the next 5 years. And those are the two things: yield, denomination, and monetary premium. Those are the two categories, in my opinion.
Okay, quick follow-up, Sam. What's your take on non-USD stablecoins?
I think they'll be huge, but I think there'll be even a thinner market, right, where I think 5 to 7 USD stablecoins will be like hundreds of billions of TVL, if not trillions, right, for the money game. There'll probably be 1 or 2. Of every like Euro C, like Korean won. We actually helped issue KRWQ, which is a Korean won stablecoin. It's the first one. There's Brazilian real, all of these. I think there'll only be like 1 or 2 of those just because they're smaller in terms of opportunity, but they'll also be very big.
And the demand outside of those like local economies is like zero, right? There's demand for dollars everywhere. Like there's really not that much demand for real outside of Brazil.
Well, so I mean, for us, we integrate these alternative currencies heavily because you can issue credit default swaps with alternative currencies. So instead of doing a carry trade with the Japanese yen, you can just underwrite KKR at cap and get the credit spread directly, no hedging or anything like that. So I think as more of these structured products are go live on chain, that will attract a lot of these overseas investors, and maybe through that means you could have some demand not from those markets, because if you're an American institution and you can invest Japanese yen and then hedge it out, you may be interested in it.
No, definitely that sounds interesting. Okay, Cyrille, do you have take on this?
Not really.
Not
No, I'm actually mostly interested in non-fiat denominated stablecoins designs, such like Vitalik posted an interesting article lately about an potential new approach, but it's probably off topic of institutional approaches. It's something I'm very interested about.
Okay, so what's your take on the collateral for non-fiat denominated?
Oh, his idea is to use options, basically. But I won't re-explain the whole article here.
Yeah, okay.
But that's an interesting
another
approach
panel.
to basically hedge you from different prices that matters in your daily life, such as the rent in your city, for instance.
Synthetic structured products. So I was talking about, they're not going to converge. There's going to be millions of things, right? So.
Okay. So put it in the bucket. Cool. Okay, so we have like 4 minutes left. So let's close with last question. What's the one thing or one prediction you believe your competitors are getting wrong? The development of the market.
I think real world is actually on-chain.
Okay.
That's, in my opinion, way more tangible than any trusted parties in what we usually call the real world. If you talk about cryptos to someone that doesn't know about crypto, most of the time they say, "But I don't know, it's not real. It's not just like my bill in my pocket. It's not real." But the thing is, actual blockchain immediate assets are way more real than your money that can just disappear or lose value in an instant because of a central bank decision, or because of a freezing on the centralized asset, for instance, just like USDC did on the whole protocol last week. And when you abstract trust from on-chain assets by actually doing real decentralized finance, I'm so sorry about the real world, but just actual decentralized finance, then it's way more tangible than any so-called real world asset, in my opinion. Just.
I think, I guess my contrarian take that other people might not believe is I think there's going to be a step function in growth rather than a smooth gradual one. Stablecoin market cap has been between 100 to 200 billion basically for like the past 4 or 5 years. The last uptick to that was also a step function, meaning in like 6 months, 90% of the growth happened, and then it's been in this band. I think it'll go up to like 500, 600 billion in like a matter of few months, but before we get there, it'll just keep going in this band. And so our GTM at Frax is basically building towards a world in which that step function happens, and we'll be positioned to grow 500x and in that, hopefully. Right?
Yeah, I would say for us, right, the reason we started the business is we thought that there needed to be a horizontally neutral issuer, outside of Circle and Tether, and so I would say like that's one thing I thought they were getting wrong. But I actually agree with Sam. I think the next big step function change will be having clear accounting rules for stablecoins, because that's like the sneaky thing that's and we'll get that with Genius that's preventing a lot of businesses from adopting stables.
Okay, and accounting rules, globally.
Yeah, like just in the United States, right? So I'll give an example. Real multinational business that I know well, their annual audit from PwC almost got blown up last year because they had stablecoins on their balance sheet. If you're the CFO of that business, you're like, why am I going through this headache for $10 million of stablecoins, right? So I think that'll help accelerate adoption.
Okay, thanks.
For us in the credit space, I think a lot of folks are trying to tokenize private credit, and I think it's unwise because private credit today is not set up with the right incentive structures. The people that are running these funds are not aligned with the depositors, and time and time again we see blowups. Why? Because these people are incentivized to just deploy, and you have funds of hundreds of billions of dollars that are run by investment committees of 30 people. How are you going to deploy that? And so I think instead of trying to just bring all these assets on chain that are extremely risky, why don't we use smart contracts to limit how much these institutions can harm their depositors, and to protect retail from fraud, right? Like, why can't all these CLOs be on chain? I think that's going to be the key. Yeah,
but there's this one product that people are trying to get people to loop on chain. It's like $1 billion private credit fund that has like 5% quarterly redemptions. And I haven't said anything publicly, but if you get that in any size, that thing is going to like totally blow up in people's
my marketing
faces.
team that's here today, it tells me I can't mention them by name, but yeah, you have these
very large, well-known private credit firm.
They come to all these conferences and they're like, "Please give me loans, and I will borrow at 4% APR." And it's like, okay, you're lending, you're giving them liquidity, but you don't know what you're doing. I mean, that can end really poorly. anyways, I
So
believe in
buy,
smart contracts.
buy it back at 50% discount to NAV.
Okay, I think this is a good closure for this.